Before we begin, a quick and important disclaimer. The content provided in this presentation is strictly for educational, historical, and entertainment purposes only. The discussions surrounding marital contracts, legal frameworks, financial risk mitigation, and the conceptual frameworks of divorce insurance do not constitute professional legal advice, financial planning, or insurance recommendations. Family law and asset protection regulations vary significantly by jurisdiction, and the historical trends we are examining do not reflect current legal realities in every state or country. We are exploring potential outcomes and historical case studies to better understand the evolution of these systems. Always conduct your own thorough due diligence and consult with licensed legal professionals, certified financial planners, and qualified insurance brokers regarding your specific personal circumstances before making any legally binding decisions or altering your financial strategies. We have been deeply conditioned to view marriage through the highly stylized, profoundly romanticized lens of a Hollywood script. Society trains us from a young age to focus exclusively on the emotional narrative, the aesthetic of the wedding day, and the idealized vision of a shared future. But behind the veil of tradition and romance lies a stark, uncompromising reality that most people actively choose to ignore until it is far too late. In the United States, marriage is statistically the most dangerous, high-stakes financial transaction you will ever undertake in your entire lifetime. It is, stripped of all sentimentality, a binding corporate merger executed between two individuals, often conducted with less due diligence than a bank requires to issue a standard auto loan. When this specific type of corporate merger fails, the dissolution process is not governed by the original participants, but rather by the heavy, indifferent hand of the state. It is a process that systematically destroys generational wealth, forces the liquidation of carefully built assets, and fundamentally alters the socio-economic trajectory of everyone involved. Consider this deeply unsettling reality. In any other high-risk venture where the statistical probability of failure hovers around 50%, financial markets immediately develop mechanisms to hedge that risk. If you buy a house, you are mandated to purchase homeowners insurance to protect against the rare probability of a fire. If you operate a vehicle, auto insurance is a strict legal requirement to shield you from the financial fallout of a collision. Yet, when entering into a legal union where the historical trends show a massive probability of critical failure, a failure that routinely results in the halving of net worth and the incurring of exorbitant legal liabilities, the prevailing societal strategy is simply blind optimism. But what if I told you that the modern financial devastation of divorce is not an accident of nature, but a direct result of a carefully orchestrated historical evolution of property laws? And more importantly, what if I told you that long before modern prenuptial agreements became a standardized tool for the ultra-wealthy, there was a deeply suppressed, highly controversial movement to commodify and underwrite the risk of a broken marriage? Today we are opening the vault on one of the most fascinating, deliberately obscured chapters in American financial and legal history. We are going to explore the precise mechanics of how marital contracts evolved from aggressive instruments of total property transfer into the highly contentious, highly litigated documents we see today. But the core of our journey is an investigation into the precursor of a concept that terrifies traditionalists and fascinates actuaries: divorce insurance. We are going to examine the early, shadow versions of this concept, exploring how historical families attempted to privately underwrite the risk of spousal abandonment and legal separation long before the insurance industry dared to touch the concept. To understand why this matters to you today, we must first reconstruct the legal architecture of the past, because the ghosts of these archaic laws still haunt the American legal system. In the early days of the American Republic, drawing heavily from English common law, the concept of a marital contract was governed by the doctrine of coverture. Under this doctrine, a woman's legal rights and obligations were entirely subsumed by those of her husband. She was considered a femme covert, meaning her very legal identity was suspended during the marriage. Any property she brought into the union, any inheritance she received, and any wages she might earn instantly became the absolute property of her husband. The marriage contract was not a partnership agreement. It was a total and complete transfer of assets and legal autonomy. However, this system, while heavily skewed, recognized the inherent vulnerability it created. Because absolute financial ruin was a very real potential outcome for a woman if her husband died or abandoned her, early legal systems developed crude, rigid mechanisms to act as a primitive form of insurance. These were concepts like the dower right, which legally entitled a widow to a specific portion, typically 1/3, of her deceased husband's real estate for the remainder of her life, regardless of what his will stated. This was an early blunt force attempt to mitigate the catastrophic risk of a dissolved household. But as the American economy shifted aggressively from agrarian land-based wealth to an industrialized, liquid and market-driven economy in the late 19th and early 20th centuries, these ancient land-based protections became entirely obsolete. As wealth became mobile, hidden in stocks, bonds, and banking ledgers rather than locked in hundreds of acres of farmland, the financial risk of marital dissolution skyrocketed. If a marriage fell apart in the Gilded Age, the lack of modern contractual protections meant that the ensuing legal battles were utterly destructive. We can look at historical case studies of prominent, wealthy families where the absence of a predefined exit strategy led to decades of litigation, public scandal, and the complete evaporation of massive fortunes into the pockets of attorneys. The realization began to dawn on the financial elite that relying on the state's default legal framework to divide complex assets was tantamount to financial suicide. This realization birthed the very first conceptual rumblings of what we would eventually recognize as divorce insurance. Actuaries and financial theorists began to quietly ask a highly controversial question. If human mortality, maritime shipping disasters, and industrial accidents could be quantified, priced, and insured against, why couldn't the statistical probability of a marriage failing be underwritten? The primary hurdle, of course, was the concept of moral hazard, the fear that insuring against a divorce would actively incentivize people to destroy their marriages for financial gain. But the foundational idea was sound. Placing a financial safety net under a legal contract that is statistically prone to catastrophic failure. By the end of this deep dive, your entire perspective on relationship equity, asset protection, and legal liability will be permanently altered. You will understand exactly how the default state laws you unknowingly submit to on your wedding day were designed, who they actually benefit, and why the evolution of marital contracts is the single most important financial history lesson you were never taught. We will dissect the early models of how trust funds and strategic dowries acted as unwritten insurance policies, how the introduction of no-fault divorce completely inverted the risk matrix for the American household, and how understanding these historical mechanisms provides you with the ultimate framework to protect your current and future assets. You will no longer view a marriage license as merely a romantic certificate, but as the most complex, highly leveraged financial derivative you will ever hold in your portfolio, requiring the exact same level of rigorous risk management as any other major investment. To truly grasp the magnitude of this financial derivative we call marriage, imagine, if you will, a modern scenario set right now in the year 2026. Consider a professional named Michael residing in Chicago, Illinois. Michael has spent a decade building a robust portfolio consisting of index funds, a burgeoning tech startup, and a modest real estate holding. He meets Sarah, equally successful, holding substantial vested stock options and a private medical practice. When Michael and Sarah stand before a state official and sign their marriage license, they are not merely declaring their affection. They are instantaneously executing a complex legal merger governed by the Illinois Marriage and Dissolution of Marriage Act. Without drafting their own explicit contractual terms, they are defaulting to a state-mandated regulatory framework. They are essentially handing the complete algorithmic control of their combined net worth over to a family court judge whose future rulings will be based on fluctuating legal precedents rather than the couple's original intentions. This modern reality, where liquid assets can be halved or tied up in years of brutal litigation, is a direct byproduct of a massive historical shift in how society prices and manages relational risk. To understand how we arrived at this precarious point, we must wind the clock back and examine the historical trends of the late 19th century, a period that fundamentally rewrote the financial DNA of the American household. During the Gilded Age, the United States transitioned violently from an agricultural economy grounded in static land ownership to a hyper-aggressive industrial economy, fueled by liquid capital, railroad stocks, and corporate bonds. This economic explosion created unprecedented wealth, but it also introduced an unprecedented vulnerability into the institution of marriage. When wealth was primarily land, it was inherently difficult to steal or conceal. A husband under the old laws of coverture controlled the land, but he could not easily pack up a 500-acre farm and disappear into the night. The physical nature of the asset provided a bizarre, rudimentary form of security. However, once wealth transformed into bearer bonds, shares in the Standard Oil Company, and vast sums of cash deposited in New York banks, the entire risk profile of a marital union completely inverted. A disgruntled spouse could now liquidate an entire family fortune in a single afternoon and board a train to a non-extraditing jurisdiction. The elite families of the era recognized this terrifying new reality. They understood that the default legal system was entirely inadequate for protecting liquid generational wealth from the massive statistical probability of human fallibility, infidelity, or simple marital breakdown. They needed a financial shield. They needed an early, conceptual form of divorce insurance. Because commercial insurance companies considered the underwriting of marriage to be morally reprehensible and statistically impossible to price at the time, the wealthy elite had to engineer their own private, decentralized insurance networks. They achieved this through the aggressive weaponization of the legal trust. Let us examine a historical case study of how this precursor to modern asset protection operated in practice. Consider a prominent industrialist family in 1890 preparing to marry off their daughter, Elizabeth, to a charismatic but financially unproven railroad executive. Under the traditional expectations of the era, the bride's family would provide a substantial dowry, essentially a massive injection of capital into the new husband's absolute control. But observing the rising trends of marital discord and the newfound ease of capital flight, Elizabeth's father refused to hand over raw liquidity. Instead, he deployed a sophisticated legal instrument known as a spendthrift trust. He transferred $1 million of highly lucrative railroad bonds not to the husband, but to a heavily restricted trust managed by a ruthless consortium of family bankers. The terms of this trust were meticulously designed to simulate the payout structure of an insurance policy. The trust would pay a consistent annual dividend to Elizabeth and her husband to maintain their lavish lifestyle. However, the husband was strictly forbidden from ever touching the principal investment. He could not sell the bonds, he could not borrow against them, and he could not use them to cover his own speculative business debts. This legal architecture served as a brilliant invisible force field. If the marriage succeeded, the couple lived comfortably on the yielded interest. But if the potential outcome shifted toward disaster, if the husband became insolvent, initiated a severe legal separation, or abandoned the family, the core wealth remained entirely untouchable by his creditors or by him. The principal was legally walled off, preserved to financially support Elizabeth and her future children. This was not merely estate planning. This was a highly calculated, privately funded insurance policy against the dissolution of the marriage. It transferred the risk of a failed merger away from the vulnerable individual and placed it squarely on the shoulders of an impenetrable legal entity. Simultaneously, a massive legislative earthquake was fracturing the foundation of American family law, forcing even the middle class to reevaluate the financial structure of their households. Beginning slowly in the mid-19th century and accelerating rapidly toward the dawn of the 20th century, individual states began passing iterations of the Married Women's Property Acts. Before these acts, as we established, a woman suffered civil death upon marriage, losing all independent economic agency. The passage of these acts, starting most notably in states like New York, granted married women the unprecedented legal right to own property in their own name, to draft contracts, to sue, and to be sued independently of their husbands. While this was a monumental victory for civil rights, it triggered an absolute panic in the financial and legal sectors. Suddenly, the marriage contract was no longer a simple unilateral absorption of one person into another. It became a highly volatile intersection of separate and marital property, competing legal claims, and distinct economic identities. The legal system was completely unprepared for the sheer volume of complex litigation that arose when these newly empowered individuals sought to dissolve their unions. Determining who owned what portion of a liquid, industrial fortune, when a marriage collapse became an impossibly tangled web of conflicting statutes. The cost of a divorce skyrocketed, transforming from a quiet, socially stigmatized family matter into a publicly litigated financial bloodbath that could bankrupt both parties through exorbitant legal fees alone. The American public was slowly awakening to a terrifying reality. The traditional marital contract, heavily romanticized by society, was in actuality a financial liability of catastrophic proportions for which no standard safety net existed. The private trust funds utilized by the ultra-wealthy were far too expensive and complex for the average working citizen to establish. The everyday American was left completely exposed to the financial devastation of a broken home, with no mechanism to manage their risk. The gap between the absolute necessity for marital asset protection and the complete lack of accessible financial products created a massive, desperate vacuum in the market. It was a vacuum so large and so inherently risky that it attracted the attention of a rogue faction of early 20th century financial theorists and actuaries. These individuals looked at the soaring legal costs, the the destructive potential outcomes of property division, and the raw, quantifiable data of rising separation rates, and they began drafting the blueprints for a financial product that society deemed utterly scandalous. They prepared to introduce the very first commercial iterations of divorce insurance to a highly volatile American market, setting the stage for a cultural and financial battle that would shake the insurance industry to its core. The immediate aftermath of this realization triggered an intellectual gold rush among a highly specialized, fiercely ambitious sect of financial engineers during the early 20th century. As the United States transitioned through the Roaring Twenties and into the brutal economic realities of the Great Depression, the cultural fabric of the nation was fraying, and with it, the statistical longevity of the American marriage. Divorce rates, which had historically hovered at negligible fractions of a percent, were steadily climbing. More importantly, the financial penalties associated with a legal separation were becoming increasingly draconian. This era saw the aggressive enforcement of permanent alimony, a legal mechanism designed to maintain a former spouse's standard of living indefinitely. The severity of these court mandates led to the very real, very terrifying phenomenon of alimony jail, where individuals who could not meet their court-ordered financial obligations due to the collapsing economy were literally incarcerated. The potential outcomes of a failed marriage were no longer just social stigma and a division of property. They now included total financial ruin and the deprivation of physical liberty. Observing this catastrophic landscape, early actuaries saw a massive untapped market. They understood that whenever there is a statistically measurable risk of financial devastation, there is an opportunity to underwrite that risk for a premium. The challenge, however, was unprecedented. How do you assign a cold, hard mathematical probability to human emotion, relational decay, and domestic incompatibility? These rogue financial theorists began constructing primitive risk matrices based on the limited demographic data available. They analyzed historical trends regarding the age disparity between spouses, the duration of the courtship before the wedding, the respective income levels of the families involved, and even the geographic location of the household. They theorized that by pooling the premiums of thousands of married couples, they could create a massive cash reserve. If a marriage survived a predetermined duration, say 20 years, the policy could theoretically convert into a lucrative retirement annuity, rewarding the couple for their stability. However, if the marriage dissolved before that threshold, the policy would trigger a payout designed specifically to cover the exorbitant legal fees, the property division costs, and the crippling burden of mandated spousal support. Imagine if we brought this concept forward to the year 2026. Consider a software engineer named David living in Austin, Texas. David is preparing to marry and is bringing a highly illiquid, highly valuable startup equity package into the union. Under the current state laws, the commingling of those assets during the marriage could result in David losing half of his life's work if the relationship deteriorates. In a world where commercial divorce insurance existed, David could simply contact a broker, submit to a rigorous actuarial background check, assessing his relational stability, and pay a monthly premium. He would be transferring the catastrophic risk of an asset split from his own balance sheet to the deep pockets of a multinational insurance conglomerate. This sounds entirely logical from a strict asset protection standpoint. It is the exact same fundamental logic you use when you purchase a comprehensive policy for a commercial warehouse. Yet, when the early 20th century financial firms attempted to quietly pitch these marital indemnity policies to wealthy clients, they hit an impenetrable, deeply entrenched wall of cultural and legal resistance. The established insurance industry, backed heavily by religious institutions and conservative lawmakers, viewed the commercialization of marital failure as an absolute moral abomination. They weaponized a foundational legal doctrine known as insurable interest. In traditional insurance law, you can only purchase a policy on a home if you actually own the home, because you have a vested financial interest in its preservation. You cannot buy fire insurance on a stranger's house, because that would financially incentivize you to commit arson. The regulatory bodies argued that issuing a financial payout upon the dissolution of a marriage created the ultimate moral hazard. They firmly believed that if a couple knew they would receive a massive lump sum of cash upon filing for divorce, they would actively orchestrate the destruction of their own family unit purely for financial gain. This concept of moral hazard became the death knell for the early commercialization of divorce insurance. State insurance commissioners across the country aggressively preempted these products, universally declaring any contract that offered a financial reward for marital separation to be strictly void against public policy. They argued that the state had a vested, overriding interest in preserving the institution of marriage, and any financial instrument that reduced the friction or the economic pain of a divorce was inherently destructive to the fabric of society. The government effectively dictated that the financial devastation of a failed marriage was not a bug in the system, but a necessary, highly punitive feature designed to trap people within their unions through the sheer terror of bankruptcy. This regulatory blockade forced the financial elite into a corner. The commercial insurance market was legally forbidden from providing a safety net, yet the risk of massive wealth destruction remained higher than ever, especially as the American economy continued to generate vast, liquid fortunes. The reliance on complex, restrictive family trusts, as we discussed previously, was highly effective for generational wealth transfer, but it was incredibly rigid and did not address the immediate, operational realities of a modern, fast-paced marriage. The ultra-wealthy needed a new tool. They needed a legally binding framework that could achieve the exact same risk mitigation as an insurance policy, but without violating the state regulations against moral hazard. They needed a way to completely bypass the default family court system and predetermine the exact financial outcome of a separation before the marriage even began. This desperate necessity for a private, contractual bypass led the brightest legal minds of the era to resurrect and heavily modify an ancient, highly controversial legal concept. They began quietly drafting bespoke agreements that explicitly outlined the division of assets, the waiver of alimony, and the exact financial terms of a potential separation, demanding that these documents be signed in the days immediately preceding the wedding ceremony. But when the first of these aggressive modern contracts inevitably landed in front of the family court judges, the legal system exploded in outrage. The courts viewed these documents not as prudent financial planning, but as a direct, illegal assault on the authority of the state and a blatant violation of the exact same public policy laws that had killed divorce insurance. The stage was set for one of the most consequential legal battles in American history, a battle that would fundamentally redefine who actually controls your money when you say "I do." And it started with a document that almost every judge in the country initially refused to enforce. The document that caused such widespread judicial outrage was the early iteration of what we now casually refer to as a prenuptial agreement, though historically it was officially known as an antenuptial contract. In the first half of the 20th century, these contracts were universally treated with extreme suspicion and outright hostility by the American legal system. The courts operated under a rigid, heavily paternalistic interpretation of public policy, firmly believing that the state had a supreme, overriding interest in the preservation of the marital unit above all other financial considerations. Under this strict legal doctrine, a financial contract between spouses was only considered valid if it dictated the division of assets strictly in the event of a spouse's death. If the contract contained even a single clause addressing the division of property or the limitation of spousal support in the event of a divorce, the entire document was instantly rendered void by the presiding magistrate. The judicial reasoning was deeply intertwined with the exact same moral hazard argument used to crush the early commercial divorce insurance market. Judges aggressively argued that if a couple predetermined the financial terms of a separation, they were effectively removing the financial terror and the threat of bankruptcy that kept unhappy marriages intact, thereby actively incentivizing the destruction of the family unit. To understand the sheer restrictiveness and the financial danger of this environment, let us examine a historical case study highly typical of the 1940s and 1950s. Consider a wealthy manufacturing executive who, having already lost half of his liquid assets in a previous, highly publicized separation, attempts to protect his remaining corporate holdings before entering into a second marriage. He hires a team of elite attorneys to draft an airtight contract stipulating that, should the marriage fail, his new wife would receive a generous but strictly capped lump sum payment of $50,000, effectively waiving her right to pursue permanent alimony or demand a percentage of his factory operations. From a modern risk management perspective, this is a highly logical, privately underwritten insurance policy. It guarantees a specific potential outcome and protects the core business assets from forced liquidation. However, when the marriage inevitably deteriorates 5 years later, the executive presents this signed, notarized document to the presiding family court judge. The judge immediately invalidates the contract, declaring it entirely contrary to the public policy of the state. The court then proceeds to award the wife not the agreed-upon $50,000, but a massive percentage of the executive's business equity and a crippling monthly alimony mandate. The state completely overrode the private financial intentions of two consenting adults, rendering their written agreement absolutely worthless. This legal absolute created a catastrophic vulnerability for anyone holding significant wealth or complex assets. Because commercial insurance companies were legally barred from issuing policies against marital failure, and because the courts explicitly refused to enforce private contractual agreements that served the exact same protective function, individuals were left entirely exposed to the unmitigated financial wrath of the state. The family court system held an absolute, unchallengeable monopoly on determining the financial equity of a dissolved household, and their rulings were often highly unpredictable, relying heavily on the subjective moral judgments of individual magistrates rather than standardized financial algorithms or prior agreements. Wealthy families quickly realized that their privately drafted insurance policies were completely useless if the state refused to recognize the underlying contract. Let us contextualize this extreme legal vulnerability by applying it directly to the modern era. Imagine an entrepreneur named Jessica residing in Seattle, Washington right now in the year 2026. Jessica has spent the last 8 years aggressively building an artificial intelligence logistics firm, recently securing a massive round of institutional funding that values her personal equity at roughly $40 million. She is preparing to marry Thomas, a freelance graphic designer. If Jessica and Thomas were forced to operate under the restrictive legal frameworks that governed America just a few decades ago, Jessica would have zero legal mechanisms available to shield her life's work. Any contract she drafted with Thomas to predetermine asset division and protect her corporate equity in the event of a divorce would be aggressively struck down by a Seattle judge as a direct violation of public policy. The state would essentially force Jessica to gamble her entire $40 million corporate valuation on the emotional longevity of her relationship, completely stripping her of the ability to practice standard financial risk mitigation. This oppressive environment forced the financial elite to resort to increasingly extreme, highly opaque measures to protect their capital. If domestic contracts were void, and domestic trusts were subject to the piercing gaze of local judges, the wealth began to systematically move offshore. Elite families began utilizing complex, multi-jurisdictional legal entities designed specifically to starve the American family court system of jurisdiction over their assets. By moving liquid capital into untouchable overseas trusts long before the wedding day, they were forcefully creating the asset protection that the domestic laws actively denied them. This massive capital flight deeply frustrated the legal system, as the state was rapidly losing its ability to regulate and distribute the massive industrial fortunes being generated within its own borders. Furthermore, the fundamental mechanics of how a divorce was actually obtained during this era created an incredibly toxic, highly combative legal environment. Before the modern era, obtaining a legal separation required navigating the brutal fault-based divorce system. A couple could not simply declare that they were incompatible and mutually agree to part ways. The state demanded a legally recognized victim and a legally recognized perpetrator. To be granted a divorce, one spouse had to formally accuse the other of a severe transgression, typically adultery, extreme physical or mental cruelty, or complete abandonment. This requirement directly fed the court's absolute hatred of prenuptial agreements. If a contract guaranteed a husband a cheap, predetermined financial exit from the marriage, judges feared he would simply commit adultery or act with extreme cruelty, knowing his financial liability was strictly capped by the prearranged document. The contract was viewed not as a prudent financial safety net, but as a prepaid, calculated license to commit matrimonial offenses without facing the financial ruin the state deemed necessary for punishment. The combination of the rigid fault-based legal system and the absolute prohibition on protective financial contracts created a volatile pressure cooker within American society. As social dynamics rapidly shifted and the cultural stigma surrounding separation began to fracture, the desperation to escape broken marriages collided violently with the state's strict refusal to allow peaceful, predetermined financial exits. This collision resulted in the creation of a massive, heavily documented black market of perjury, staged hotel room infidelities, and entirely fake evidence, all orchestrated by desperate couples simply trying to satisfy the court's archaic demands for a victim and a villain. The legal system was drowning in its own moral rigidity, and a catastrophic breaking point was inevitable. A monumental legal earthquake was building just beneath the surface, one that would initiate in the year 1970 and completely rewrite the financial DNA of the American family, finally legalizing the exact asset protections the wealthy had been fighting for, but simultaneously introducing a catastrophic, deeply hidden financial trap that would utterly devastate the modern middle class. The year was 1970, and the epicenter of this legislative earthquake was the state of California. Governor Ronald Reagan signed into law the Family Law Act, a piece of legislation that completely abolished the traditional requirement of proving fault in a marital dissolution. For the first time in American history, a couple could legally terminate their union simply by citing irreconcilable differences. The immediate surface-level effect was a massive sigh of relief across the nation. The humiliating black market of staged infidelities and manufactured perjury evaporated almost overnight. You no longer needed a villain to escape a failing marriage. But beneath this surface-level victory for personal autonomy lay a profound, incredibly dangerous financial restructuring that would permanently alter the economic landscape of the American household. To understand the sheer magnitude of this shift, we must look at how the legalization of no-fault divorce completely annihilated the judicial resistance to prenuptial agreements. For decades, as we previously established, family court judges ruthlessly struck down any private contract that predetermined the financial outcomes of a divorce, arguing that such documents violated public policy by making separation too easy. But the moment the state of California, and soon the rest of the nation, declared that anyone could secure a divorce at any time, for any reason without proving fault, that judicial argument instantly collapsed. If the state itself was now officially facilitating easy, frictionless exits from marriage, it could no longer hypocritically claim that private financial contracts were a threat to the institution. The ideological wall fell. In a series of rapid landmark rulings throughout the 1970s, Supreme Courts across various states officially recognized the validity of prenuptial agreements. For the financial elite, this was the ultimate victory. The private, contractual divorce insurance they had been desperately seeking for half a century was finally legalized. The floodgates of asset protection burst wide open. Wealthy families immediately began deploying armies of corporate attorneys to draft microscopic, highly technical marital contracts. These were no longer just agreements. They were sophisticated corporate merger documents outlining precise equity vests, strict limitations on spousal support, and absolute firewalls around business holdings and trust funds. If a billionaire entered a marriage in 1975 and the relationship failed a decade later, the exit was purely administrative. The financial outcome was already calculated, locked in, and approved by the state. The risk of the marriage had been completely underwritten by a private document. But here is where the historical trend takes a devastating turn for the rest of the population. While the wealthy were aggressively building their financial firewalls, the American middle class was walking completely unprotected into the exact same volatile legal environment. Because prenuptial agreements had been historically illegal or reserved strictly for the ultra-wealthy, mainstream society viewed them with deep suspicion, framing them as inherently unromantic or entirely unnecessary for average wage earners. Consequently, the vast majority of the population entered the no-fault era relying entirely on the default laws of the state. They unknowingly accepted the premise that their marriage was the only major financial transaction in their lives that did not require a written risk management strategy. Consider the catastrophic potential outcomes of this cultural blind spot by looking at a scenario set right now in the year 2026. Imagine a man named Robert living in Columbus, Ohio. Robert works in middle management and has spent 15 years diligently building a modest $400,000 retirement account, while simultaneously paying down the mortgage on a suburban family home. He is married to Emily. They have no prenuptial agreement, relying entirely on the Ohio default family law statutes. Because we live in a no-fault society, Emily can wake up tomorrow, decide she is simply unfulfilled, and file for a unilateral divorce. Robert cannot stop this process. He cannot contest the dissolution. But more importantly, because there is no private contract in place, the state algorithm immediately takes control of their entire combined net worth. In this highly common modern scenario, the lack of private divorce insurance means the middle-class household must be functionally liquidated to satisfy the state-mandated division of assets. Robert's $400,000 retirement account, which took over a decade of disciplined saving to accumulate, is instantly fractured by a qualified domestic relations order, legally severing half of the capital and handing it to his spouse, utterly destroying the compound interest trajectory of his future. The family home, the primary anchor of middle-class wealth, must often be forcibly sold in a volatile real estate market, simply because neither party has the liquid cash to buy out the other's equity. When you factor in the exorbitant legal fees required to navigate this default state process, the total destruction of wealth is staggering. Robert is not just losing his marriage, he is experiencing a forced, catastrophic financial reset from which historical trends show he may never fully recover. The introduction of no-fault divorce essentially created a highly leveraged, unhedged financial liability for the average American. In the old system, the difficulty of obtaining a divorce acted as a bizarre, friction-based mechanism that kept assets consolidated. Once that friction was removed, the statistical probability of a marriage dissolving skyrocketed, but the underlying legal mechanics of asset division remained brutally punitive. The middle class was suddenly participating in a high-frequency, high-risk legal maneuver, without any of the contractual safety nets utilized by the wealthy. The romanticization of the marital contract blinded the general public to the cold, hard actuarial reality that a marriage license had become the single most dangerous piece of paper an average citizen could sign. As the decades progressed from the 1970s into the late 20th century, the sheer volume of middle-class wealth being destroyed in family courts forced state legislatures to scramble. They realized that their default algorithms for splitting property were causing massive economic instability. In a desperate attempt to fix the crisis they had created, lawmakers across the country began completely rewriting the rules of property ownership, splitting the United States into two distinct, highly complex legal frameworks known as community property and equitable distribution. But instead of creating fairness, this new legislative experiment introduced a terrifying new layer of risk, one that allowed a spouse's secret financial behavior, hidden debts, and reckless investments to seamlessly cross the marital barrier and legally attach to your personal income, setting the stage for a new era of financial sabotage that most people still do not realize exists until the process server knocks on their door. This process server does not arrive to inform you merely that your relationship has ended, but to officially notify you that your entire financial existence has been completely subsumed by the default algorithmic machinery of the state. To comprehend how we arrived at this terrifying juncture, we must thoroughly dissect the legislative panic that occurred as state governments realized their no-fault divorce systems were financially liquidating the American middle class. In a desperate bid to establish order out of the chaotic, unregulated destruction of household wealth, the United States effectively fractured its family law architecture into two distinct, highly complex, and equally dangerous legal doctrines. These are the frameworks of community property and equitable distribution. For the average citizen operating without the private insurance of a prenuptial agreement, these default frameworks act as a massive, invisible net that violently catches anyone who stumbles into the family court system. Let us first examine the terrifying historical trends and potential outcomes associated with the community property framework, a system currently utilized by a minority of states, including massive population centers like California and Texas. The foundational theory of community property is superficially romantic but fundamentally draconian in its actual economic application. It dictates that from the exact moment you sign your marriage license, any income earned, any asset acquired, and critically, any debt incurred by either spouse is instantly classified as being owned equally by the marital community. It completely erases individual financial autonomy. The state simply views the married couple as a single, indivisible corporate entity. If your spouse earns $1, 50 cents of it belongs to you. But conversely, and far more dangerously, if your spouse borrows $1, you legally owe 50 cents of that debt, regardless of whether you consented to the loan, benefited from the capital, or even knew the transaction existed. To visualize the catastrophic financial sabotage this default algorithm can inflict in the modern era, imagine a scenario set right now in the year 2026. Consider an architectural engineer named Marcus residing in Dallas, Texas. Marcus is incredibly financially conservative. He carries zero consumer debt, maximizes his retirement contributions every single month, and meticulously maintains an elite credit score. He marries an ambitious entrepreneur named Clara. Because neither Marcus nor Clara wishes to navigate the culturally stigmatized, adversarial process of drafting a prenuptial contract, they default to the Texas community property laws. They have essentially opted out of private risk management and opted into state-mandated financial symbiosis. 3 years into the marriage, without Marcus possessing any knowledge of the transactions, Clara attempts to aggressively scale her business by taking out massive, high-interest commercial loans and heavily leveraging multiple credit cards entirely in her own name. When her business venture inevitably collapses, the ensuing financial stress destroys the marriage, and they file for divorce. Under the strict default laws of community property, the state of Texas does not care that Marcus never signed a single loan document. The state does not care that his name appears nowhere on the credit card statements. Because the massive financial liabilities were incurred during the temporal window of the marriage, the state categorizes them as community debt. Marcus is suddenly legally responsible for 50% of a catastrophic financial crater he did not create. His wages can be forcefully garnished, his meticulously built retirement accounts can be liquidated to satisfy the creditors, and his pristine credit score is completely annihilated. By failing to secure a private contractual firewall, Marcus allowed his spouse's secret financial behavior to legally cross the marital barrier and detonate within his own personal economy. If you reside in the majority of the country that does not utilize community property, you are subject to the doctrine of equitable distribution, which presents a completely different, yet equally volatile matrix of risk. Equitable distribution was designed to sound incredibly fair, giving the presiding family court judge the absolute authority to divide marital assets in a manner they subjectively deem to be just and equitable. However, in the realm of financial risk management, ambiguity is the absolute enemy of security. When you submit to an equitable distribution framework, you are essentially playing a game of jurisdictional roulette. The judge will analyze a highly subjective list of factors, including the length of the marriage, the respective earning capacities of the individuals, and the standard of living established during the union. The potential outcomes are wildly unpredictable. A judge could decide to split the assets 50-50, or they could decide that one spouse deserves 70% of the liquid wealth in the family home, leaving the other completely decimated. You are surrendering the fate of your generational wealth to the absolute discretion of a single government official on a random Tuesday morning. Furthermore, both of these default state systems contain a highly destructive legal trapdoor known as transmutation. This is the silent, insidious process by which the separate, protected property you brought into a marriage is legally converted into shared marital property through simple everyday actions. Let us look at historical case studies of how this destroys middle-class wealth. Imagine you inherit a modest, paid-off single-family home from your grandparents prior to your marriage. Under the law, this is theoretically your separate property. However, if you use a single dollar of the income you earned during your marriage to pay the property taxes on that house, or if your spouse spends a weekend helping you paint the living room or repair the roof, you have officially commingled the asset. You have injected marital funds or marital sweat equity into a separate asset. In a divorce proceeding, a forensic accountant will aggressively argue that the home has been transmuted into marital property, and you will suddenly find yourself forced to buy out your spouse's newly created equity in a home that your own grandparents left exclusively to you. The wealthy elite observe these default frameworks and understand that participating in them is tantamount to financial suicide. They utilize complex postnuptial agreements, irrevocable trusts, and aggressive compartmentalization of assets to ensure that transmutation never occurs and that rogue marital debt can never attach to their primary wealth engines. They treat marriage with the exact same actuarial coldness as a corporate merger, demanding absolute clarity regarding liability and asset division. But the average American remains completely paralyzed. They recognize that the default state laws are a terrifying trap, yet they find the process of negotiating a prenuptial agreement to be prohibitively expensive, emotionally toxic, and deeply offensive to the romanticized ideals of their relationship. This massive societal paralysis created a fascinating, highly lucrative void in the market at the dawn of the 21st century. The American public was trapped between the financial terror of the state default laws and the cultural stigma of private legal contracts. They needed a third option. They needed a frictionless, mathematically sound mechanism to hedge the catastrophic risk of a failed marriage without having to sit across a mahogany table from an attorney and accuse their fiancé of being a potential liability. This profound desperation caught the attention of a new generation of rogue financial engineers and venture capitalists. They looked back at the failed, morally scrutinized insurance concepts of the 1920s and realized that modern data analytics and internet distribution could completely revolutionize the underwriting process. They set out to build the holy grail of asset protection, a literal commercial divorce insurance policy that you could purchase quietly online, setting the stage for a spectacular financial experiment that would directly challenge the legal establishment and attempt to finally commodify the risk of a broken heart. The early 2000s internet boom provided the perfect fertile ground for this highly controversial financial experiment. As venture capital flooded into Silicon Valley, a completely new breed of financial engineers began analyzing the archaic, deeply inefficient systems of family law. They looked at the staggering historical trends of marital dissolution and saw an extraordinarily massive, entirely unserved market. The American public was terrified of the family court system, exhausted by the combative nature of prenuptial agreements, and desperate for a modernized safety net. These rogue startups set out to create the first true, commercially viable divorce insurance, a product that could be purchased anonymously online, fundamentally altering the landscape of relational risk management. To achieve this, these startups had to solve a mathematical problem that had baffled the insurance industry for over a century. How do you accurately price the statistical probability of human emotional failure? Traditional life insurance relies on rigid, biological mortality tables. Auto insurance relies on traffic collision data and vehicle safety ratings. But pricing a marriage required building an entirely new actuarial matrix. These companies began aggregating decades of sociological and demographic data to identify the precise variables that correlated with marital collapse. They analyzed the age of the individuals at the time of the wedding, the disparity in their respective income levels, their highest completed levels of education, and even their geographic location, noting that the historical trends of separation in urban financial centers differed wildly from rural agricultural communities. By feeding this data into sophisticated algorithms, they were able to generate a standardized risk profile for the modern American household. The resulting product was a masterclass in financial compartmentalization. Instead of offering a blank check that would trigger the moral hazard alarms of state regulators, these companies structured the insurance using a rigid system of coverage units. A consumer could not simply buy $1 million policy. They purchased units of coverage, with each unit corresponding to a specific monthly premium and guaranteeing a fixed payout. But the true genius of these early policies, and the mechanism designed entirely to appease the hostile state insurance commissioners, was the implementation of a draconian vesting period. Imagine if we apply this exact structural framework to a modern scenario set right now in the year 2026. Consider a senior cloud architect named Kevin residing in Miami, Florida. Kevin has witnessed multiple colleagues lose half of their vested stock options in brutal legal battles, and he is determined to protect his own rapidly growing portfolio. He is deeply in love with his fiancée, an independent marketing consultant, and he absolutely refuses to introduce the toxic, adversarial negotiation of a prenuptial agreement into their relationship. Instead, Kevin quietly downloads a specialized financial technology application and applies for a marital casualty policy. The underwriting process is entirely digital. Kevin inputs their demographic data and selects a coverage plan that costs $100 per month. However, the policy explicitly states that it features a strict 48-month vesting period. If Kevin and his spouse file for divorce at any point during the first 4 years of the policy, the insurance company pays absolutely nothing, and Kevin simply forfeits the accumulated premiums. This vesting period is the ultimate actuarial firewall. It is mathematically designed to eliminate insurance fraud. The financial engineers calculated that the statistical probability of two people maintaining a highly dysfunctional, actively collapsing marriage for 4 consecutive years solely to collect a $50,000 payout was incredibly low. The psychological toll of the relationship would vastly outweigh the potential outcomes of the financial reward. If Kevin's marriage survives the crucial 4-year vesting period, the policy activates. From that point forward, every additional month he pays his premium, his total potential payout increases incrementally. If 10 years down the line the marriage suffers an irreconcilable breakdown and the couple files the legal paperwork for a dissolution, the policy triggers its execution phase. Upon receiving the official court stamp petition for divorce, the insurance company immediately wires the predetermined cash settlement directly into an independent bank account controlled solely by Kevin. This payout mechanism is absolutely critical to understand because it fundamentally bypasses the entire jurisdiction of the family court. The cash received from this policy is not categorized as marital property subject to equitable distribution or community property laws. It is a third-party contractual indemnity payment. Kevin instantly has the liquid capital required to hire an elite family law attorney, secure a new primary residence, and manage the immediate catastrophic cash flow disruption that ruins so many individuals during the initial phases of a separation. He has successfully utilized modern financial technology to privately underwrite his own relational risk, completely circumventing the state-mandated algorithms that we examined in our previous discussions. When these products initially launched, they caused an absolute uproar within the legal establishment. State regulatory bodies, heavily lobbied by traditional family law attorneys who saw their lucrative monopolies being threatened, immediately attempted to shut them down. They argued that these policies were not casualty insurance, but rather unregulated surety bonds. They resurrected the exact same moral hazard arguments from the 1920s, claiming that providing a soft financial landing for a divorce actively encouraged the destruction of the family. The startups fought back viciously in the courts, arguing that their strictly capped payouts and exhaustive vesting periods completely neutralized the threat of moral hazard. They pointed to case studies showing that their clients were not using the money to profit from a divorce, but simply to survive the exorbitant legal fees mandated by the state's own inefficient legal system. For a brief, spectacular window of time, it appeared that the rogue actuaries had won. The financial media praised the innovation, and thousands of highly cautious, mathematically minded individuals flocked to these platforms to secure their financial futures. The concept of commodifying the risk of a broken heart had seemingly transitioned from a theoretical impossibility into a standardized retail financial product. However, beneath the surface of this rapid expansion, a catastrophic, completely fatal flaw was silently eroding the mathematical foundation of the entire business model. The algorithms had perfectly calculated the demographic risks, and the vesting periods had successfully eliminated short-term fraud, but the financial engineers had vastly underestimated a deeply psychological, uniquely human phenomenon known as adverse selection. They were about to discover that when you offer a financial product specifically designed to mitigate the devastation of a failing relationship, you attract a very specific, highly dangerous demographic of consumer. The data flowing into the underwriting departments began to reveal a terrifying reality about exactly who was purchasing these policies, initiating a massive internal panic that would force the complete collapse of the first generation of divorce insurance and pave the way for a highly secretive, aggressive new tactic currently utilized by the modern elite. To understand this fatal mathematical flaw, we must dissect the core economic principle of adverse selection, a concept that fundamentally dictates the survival or destruction of any risk-pooling financial system. In a traditional, highly functional insurance market, the system relies on a massive pool of individuals who are completely terrified of a catastrophic event, yet statistically highly unlikely to experience it in the near term. When millions of healthy 30-year-old citizens purchase standard life insurance, they are actively subsidizing the payouts for the statistical anomaly of the few who tragically pass away early. The massive influx of their premiums creates a solvent, deeply capitalized financial reserve. But the pioneers of commercial divorce insurance vastly misunderstood the psychological profile of the consumer they were attempting to acquire. A deeply committed couple currently existing in a thriving, mutually beneficial marital ecosystem rarely wakes up on a random Tuesday morning and decides to allocate $100 of their monthly household budget to hedge against a relational collapse they cannot even fathom. The data flowing into the underwriting departments of these early financial technology startups revealed a chilling reality regarding exactly who was clicking the purchase button. The client base was not a diversified, randomized sample of the American public. Instead, the market was entirely cornered by individuals who were already consciously observing severe, foundational cracks in their marriages. The product was overwhelmingly purchased by spouses who were actively enduring financial infidelity, emotional detachment, or escalating domestic hostility. They were not buying a safety net against an unpredictable future storm. They were heavily subsidizing their preparation for an inevitable, calculated legal war. The actuaries had assumed the 4-year vesting period would act as an impenetrable barrier against this behavior. They assumed that a deeply unhappy individual would simply not possess the psychological endurance to remain in a highly toxic household for 48 consecutive months, merely to collect a $50,000 payout. They were catastrophically wrong. The financial engineers had profoundly underestimated the sheer patience and the cold, calculated financial endurance of a spouse preparing for a deeply contested separation. Historical trends demonstrated that disgruntled individuals viewed the monthly premium not as an expense, but as a highly leveraged, aggressive savings account. They quietly paid their premiums, secretly endured the deteriorating household environment, and literally counted the days on the calendar until the 48-month vesting threshold was crossed. Once that mathematical barrier was breached, the floodgates opened. The startups were suddenly hit with a massive, highly coordinated wave of legal claims. Because the entire risk pool was artificially saturated with high-risk participants, the payouts began to completely obliterate the collected premiums. The mathematical models shattered. The venture capital funding that had propped up the early infrastructure evaporated as institutional investors realized the fundamental unit economics of the product were structurally impossible to balance. Simultaneously, the hostile state insurance regulators, observing this rapid financial bleeding, moved in for the final decisive blow. Armed with raw data showing that these policies were indeed facilitating calculated marital exits, they successfully revoked the operational licenses of these pioneer companies across multiple key jurisdictions. The grand, highly publicized experiment to democratize asset protection and provide a frictionless, commercially viable safety net for the American middle class ended in a spectacular financial implosion. The average citizen was left stranded right back where they started in the 1970s, completely exposed to the brutal, unyielding default laws of equitable distribution and community property, with their only defense being a highly combative, culturally stigmatized prenuptial agreement. However, while the retail insurance market was loudly collapsing under the weight of adverse selection, the financial elite were quietly constructing an entirely different, heavily insulated, and incredibly aggressive legal architecture. They observed the failure of the commercial models and realized that waiting for a marriage to dissolve to trigger a defensive cash payout was a fundamentally flawed strategy. The new objective was not to insure the assets against a family court judge, but to completely remove the assets from the legal definition of ownership entirely, long before the marriage even took place. They engineered a transition from reactive insurance to proactive, impenetrable legal fortresses, birthing the era of the Domestic Asset Protection Trust. Historically, if a wealthy American citizen wanted to legally hide capital from a domestic family court judge or a hostile creditor, they were forced to move their liquidity offshore to jurisdictions like the Cook Islands or the Cayman Islands. This was expensive, logistically complex, and drew immense regulatory scrutiny. But starting in the late 1990s and exploding into mainstream elite wealth management by the early 2000s, a highly controversial legal revolution occurred within the borders of the United States. Certain sovereign states, most notably South Dakota, Nevada, Alaska, and Delaware, realized they could attract billions of dollars in trust capital by aggressively rewriting their own internal banking laws. They created legal environments designed specifically to protect wealth from the claims of future spouses, explicitly nullifying the traditional reach of family court systems from other states. To visualize exactly how this aggressive tactic operates in the modern era, imagine a scenario taking place right now in the year 2026. Consider a highly successful commercial real estate developer named Richard operating out of New York City. Richard has accumulated $80 million in liquid capital and commercial property equity. He is preparing to marry, but his family office adamantly refuses to rely on a New York prenuptial agreement, knowing that aggressive litigation can sometimes pierce or invalidate those contracts. Instead, 12 months before he even purchases an engagement ring, Richard works with specialized legal counsel to establish a self-settled spendthrift trust domiciled entirely in the state of South Dakota. He legally transfers his entire $80 million portfolio into this specific trust. Under the aggressive, highly protective statutes of South Dakota, Richard can be named as a discretionary beneficiary of his own trust. This means he can still request and receive massive distributions of cash from the independent trustee to fund his lavish lifestyle. He still practically enjoys the wealth. However, legally speaking, Richard no longer owns a single dollar of that $80 million portfolio. The trust is an entirely separate, sovereign legal entity. When Richard finally stands before an officiant in New York and signs his marriage license, he is, on paper, completely impoverished regarding those core assets. He has fundamentally altered the baseline reality of his personal net worth. If Richard's marriage eventually collapses 5 years later, the New York family court judge will immediately attempt to locate and divide the marital assets under the state's equitable distribution laws. His spouse's legal team will inevitably discover the $80 million portfolio and demand a massive percentage. But because the assets are legally domiciled within the South Dakota Trust, they are shielded by state laws that explicitly refuse to recognize out-of-state family court judgments regarding trust property. The New York judge has zero jurisdictional authority to force the South Dakota trustee to liquidate or distribute those assets to a divorcing spouse. Richard has successfully utilized jurisdictional arbitrage to completely defund the family court system before the trial even initiated, legally starving his opposing counsel of the capital required to wage a protracted legal war. This aggressive maneuvering created an impenetrable financial fortress for the ultra-wealthy, completely bypassing the need for traditional insurance. But this exact strategy sparked a brutal, all-out constitutional war between competing state jurisdictions, leading to the creation of a massive, highly controversial federal loophole that allows the modern elite to legally hide their marital assets in plain sight, a complex legal vulnerability that we must systematically dissect as we continue our investigation into the ultimate evolution of American asset protection. To fully grasp this complex legal vulnerability, we must first examine the constitutional paradox that makes this geographic arbitrage possible. The Founding Fathers embedded a critical mechanism into the United States Constitution, known as the Full Faith and Credit Clause. This clause dictates that every state must respect and enforce the public acts, records, and judicial proceedings of every other state. If a court in Ohio issues a valid judgment for a monetary debt, you cannot simply flee to Florida to escape it. The Florida courts are constitutionally bound to help collect that debt. However, the modern deployment of the Domestic Asset Protection Trust fundamentally fractures this constitutional mandate, creating a highly lucrative, heavily litigated gray area that family law attorneys refer to as jurisdictional warfare. When states like South Dakota, Nevada, and Alaska aggressively rewrote their trust codes, they intentionally drafted legislation that acted as a legal firewall against the Full Faith and Credit Clause specifically concerning family court judgments. They enacted statutes declaring that their local trustees are strictly prohibited from distributing trust assets to satisfy the demands of an out-of-state divorce decree. This created a paradoxical shadow legal system. The state where the marriage occurred has the absolute authority to divide the assets, but the state where the assets are actually housed has the absolute authority to refuse the division. Let us apply this historical trend to a concrete scenario set, right now in the year 2026. Imagine a highly compensated tech executive named William, residing in Los Angeles, California. California, as we have previously established, operates under a brutal community property regime. Knowing the catastrophic potential outcomes of a failed marriage in this jurisdiction, William coordinates with a specialized wealth management firm long before he meets his future spouse. He establishes a domestic asset protection trust in Nevada, legally transferring $30 million of pre-IPO company stock into the trust corpus. 3 years later, William marries. 5 years after that, the marriage inevitably deteriorates, and his spouse files for a dissolution of marriage in a Los Angeles family court. The California judge, strictly applying community property algorithms, looks at the financial timeline and recognizes that while the stock was initially acquired before the marriage, its massive appreciation in value occurred during the marital window. The spouse's forensic accountants demand half of the appreciated value, a sum totaling roughly $20 million. The California judge issues a legally binding order compelling William to liquidate the shares and transfer the funds. However, William does not legally own the shares. The Nevada trustee owns the shares. When the California court order arrives on the desk of the trust officer in Las Vegas, the officer simply points to the Nevada revised statutes, which explicitly forbid the distribution of trust assets to satisfy an out-of-state spousal claim. The California judge is completely paralyzed. The court cannot hold William in contempt, because he literally lacks the legal authority to force the trustee to release the funds. The court cannot sanction the Nevada trustee because the trustee is operating entirely within the legal bounds of their own sovereign state. Why is this allowed to happen? The legal architecture hinges on the precise definition of a creditor. In traditional contract law, if you borrow money from a bank and then transfer all your assets into a trust to avoid paying the bank, that is considered a fraudulent conveyance, and the court will immediately pierce the trust. The bank is a known existing creditor. But in the realm of proactive asset protection, a future spouse is classified merely as a potential future creditor. Because William established the Nevada trust years before the marriage was even a conceptual reality, he was not defrauding a known creditor. He was simply engaging in prudent, legally sanctioned risk management against an unknown future liability. By the time the spouse officially transitions from a romantic partner into a hostile legal adversary, the statute of limitations on challenging the initial transfer of assets into the trust has long since expired. This strategy perfectly illustrates the historical evolution of how the American financial elite effectively opt out of the default legal system. While the middle class is completely trapped by the unpredictable rulings of equitable distribution and the rigid 50-50 splits of community property, those with sufficient capital construct bespoke legal realities. They do not need to rely on the culturally stigmatized, heavily contested negotiation of a prenuptial agreement, which requires the active consent and signature of their partner. A domestic asset protection trust is entirely unilateral. The spouse does not need to agree to it, sign it, or even know of its existence until the very moment the divorce litigation begins. It is the ultimate evolution of the unwritten marital contract, a stealth insurance policy functioning quietly in the background of the relationship. The true power of the domestic asset protection trust in a divorce proceeding is not merely the legal shielding of the capital, but the complete destruction of the opposing party's legal leverage. In a standard divorce, attorneys operate on the assumption that a massive pool of liquid assets will eventually be divided, allowing them to extract their exorbitant hourly fees from the marital estate. When an attorney discovers that the core wealth is locked behind a Nevada or South Dakota statutory firewall, the entire economic incentive to litigate evaporates. They realize they could spend hundreds of thousands of dollars in legal fees waging a multi-state jurisdictional war, with an incredibly low statistical probability of success. This psychological realization forces the opposing spouse to the negotiating table, compelling them to accept a modest, predetermined cash settlement, rather than risking total financial ruin in a futile legal crusade against an impenetrable sovereign trust. This forced capitulation achieves the exact same financial outcome as the early, outlawed prenuptial agreements of the 1940s, but it executes the maneuver through raw jurisdictional superiority rather than mutual contractual consent. It is a brilliant, ruthless application of legal geography to achieve total asset immunity. However, this strategy is not without extreme, highly volatile friction. The widespread adoption of these aggressive trust structures has enraged family court judges nationwide. Seeing their authority openly mocked by out-of-state trust companies, aggressive litigators have begun searching for alternative methods to break the firewall. If they cannot penetrate the trust through state family courts, they attempt to drag the entire financial structure into the federal arena. They look for vulnerabilities in federal bankruptcy courts, attempting to leverage the 10-year look-back period for fraudulent transfers under the National Bankruptcy Code. This creates an incredibly complex, highly specialized legal battleground where the rules of engagement are constantly shifting based on recent appellate court decisions, and where a single misstep in trust administration can instantly collapse the entire protective structure. The American family court system is currently trapped in a desperate arms race against these sovereign trust jurisdictions. But while state judges are losing the battle against geographical arbitrage, a completely new, entirely unregulated frontier of marital asset protection is rapidly expanding beneath the surface of the traditional banking system. As we transition from the analog legal frameworks of the 20th century into the decentralized realities of the modern era, the very definition of property is undergoing a massive, irreversible transformation. What happens when the assets are no longer held in a South Dakota trust company, but are instead scattered across a mathematically impenetrable, globally decentralized network that answers to absolutely no government on Earth? We are about to uncover the most aggressive, highly secretive asset protection strategy currently being deployed by the technological elite, a system that fundamentally erases the concept of marital property and threatens to render the entire American family court system permanently obsolete. To completely eradicate the jurisdiction of a family court judge, the modern technological elite have realized they no longer need to rely on the geographic boundaries of South Dakota or the legislative loopholes of Nevada. They are migrating their wealth into a realm where physical geography and state sovereignty are entirely irrelevant. We are talking about the explosive, unregulated frontier of decentralized finance, cryptographic ledgers, and self-custodial digital assets. For the entire history of American jurisprudence, the power of a family court to enforce an equitable distribution order or a community property split relied on a single fundamental vulnerability. The court could simply issue a subpoena to a centralized banking institution, and the bank, fearing regulatory wrath, would immediately freeze the accounts, liquidate the assets, and wire the capital exactly where the judge commanded. The state possessed the ultimate monopoly on financial force. But the advent of blockchain technology has fundamentally shattered that monopoly. Consider a scenario operating right now in the year 2026. Imagine a software architect named Alex residing in Miami, Florida. Over the past decade, Alex has accumulated roughly $12 million in net worth. However, unlike the historical elite who locked their wealth in massive real estate portfolios or centralized brokerage accounts, Alex holds this entire fortune in various cryptographic tokens, completely detached from the traditional financial system. These assets are secured by a private cryptographic key, a complex string of alphanumeric characters stored offline on a piece of hardware no larger than a standard thumb drive, or perhaps even memorized solely in his own mind. When Alex enters into a marriage, there is no paper trail for a future spouse to easily track. There is no centralized bank account generating monthly statements. If this marriage eventually deteriorates and the couple enters the chaotic arena of divorce litigation, the traditional legal machinery grinds to an absolute halt. When the opposing forensic accountants demand access to the marital estate, Alex simply declares a massively deflated net worth. The spouse's legal team immediately issues subpoenas to every major American bank and brokerage firm, searching for the hidden millions. The subpoenas return absolutely nothing. Because Alex acts as his own sovereign bank, there is no corporate entity for the judge to compel. The state cannot seize what it cannot mathematically access. The $12 million exists on a globally decentralized ledger, and without the exact private key, the combined computational power of the entire United States government cannot force the transfer of a single digital cent. This creates an unprecedented legal paradox that is currently terrifying the American judicial system. The court may possess overwhelming circumstantial evidence that Alex is hiding massive wealth. They may analyze his lavish lifestyle and his historical income trends, concluding with absolute certainty that the capital exists. But mathematical encryption creates an impenetrable wall. In response to this technological defiance, frustrated family court judges are resorting to the only weapon they have left in their arsenal. If they cannot physically seize the digital asset, they attempt to seize the individual. Courts are increasingly utilizing the draconian power of civil contempt, literally incarcerating individuals like Alex until they agree to surrender their private cryptographic keys and repatriate the hidden wealth back into the marital estate. It is a brutal game of psychological attrition, pitting the infinite patience of a mathematical algorithm against the physical endurance of a human being locked in a county jail cell. However, the technological elite are already engineering sophisticated countermeasures to bypass even the threat of physical incarceration. They are deploying advanced cryptographic protocols known as multi-signature wallets and time-locked smart contracts. In these incredibly complex setups, Alex could program his digital wealth so that he alone cannot authorize a transaction. The code might require the digital signature of 3 independent, anonymous trustees located in different global jurisdictions to move the funds. If a judge orders Alex to surrender his assets under the threat of imprisonment, Alex can truthfully testify that it is technologically impossible for him to comply on his own. The smart contract simply will not permit the transfer. The asset is mathematically frozen, suspended in a decentralized void, completely untouchable by the divorcing spouse, the opposing attorneys, and the furious magistrate. This evolution brings us to the absolute pinnacle of marital risk management, a concept that perfectly mirrors the outlawed divorce insurance policies of the early 20th century, but executes them through autonomous code rather than corporate underwriters. Technologists are currently drafting literal smart contract prenuptial agreements. 2 individuals can digitally lock a pool of liquid capital into a decentralized protocol on their wedding day. The underlying code explicitly dictates the exact algorithmic conditions of a potential dissolution. If the marriage succeeds and reaches a 10-year milestone, the protocol automatically unlocks the capital, transferring it into a joint family wallet to fund a mortgage or a retirement account. However, if the relationship fails and a digital certificate of divorce is uploaded to the blockchain, the smart contract instantaneously, and without any human intervention, executes a predefined 50-50 split, routing the exact sums to the independent digital wallets of each spouse. There are no exorbitant attorney fees. There is no subjective judicial ruling. There is no emotional courtroom warfare. The risk of the marital contract is entirely managed, priced, and executed by a cold, indifferent algorithm. When we synthesize this massive historical timeline, a profound, undeniable truth emerges regarding the American economic condition. From the archaic land protections of dower rights in the 18th century, to the secretive spendthrift trusts of the Gilded Age, to the outlawed insurance policies of the Great Depression, and finally to the cryptographic smart contracts of the modern era, the underlying human desperation remains exactly the same. The American public recognizes that tying their entire financial existence to the emotional volatility of another human being is a risk of catastrophic proportions. The legal establishment has spent 2 centuries attempting to force citizens to endure the financial devastation of a failed marriage, weaponizing the concept of public policy to maintain absolute control over the division of household wealth. Yet, at every single stage of history, financial engineers have ruthlessly innovated to bypass the state. They built trusts when contracts were illegal. They built offshore jurisdictions when domestic courts became too aggressive. And today, they are building decentralized mathematical fortresses to completely erase the jurisdiction of the family court entirely. You have now seen behind the curtain of the most dangerous, highly leveraged financial derivative in human history. You understand the hidden algorithms, the jurisdictional warfare, and the silent economic traps waiting within the default laws of the state. The romanticized illusion of the marriage license has been entirely deconstructed, revealing the raw, unforgiving corporate merger operating beneath the surface. But the evolution of relational risk management does not end with the blockchain. A new, far more invasive technology is currently being developed by data brokers, one that analyzes your biometric data, your private communications, and your micro-financial transactions to accurately predict the exact mathematical date your relationship will collapse, allowing institutional investors to quietly short your household economy long before you even realize your marriage is over.